Your money is dying right now. Every second it sits in your savings account, you're working for free. Let me show you the math that banks pray you never calculate. In 2023, the average savings account in the United States paid 0.4% interest. Inflation that same year, 4.1%. That's not a small gap. That's financial violence in a slow motion. Here's what this actually means in terms that matter, in terms of your time. Let's say you make $50,000 a year. You're trading roughly 2,000 hours of your life, your actual finite existence, for that money. Now you do the responsible thing. You save $10,000 in your bank account. The bank gives you $40 in interest for the year. Congratulations. You just earned 2 cents per hour on money that cost you 400 hours of your life to generate. But here's where it gets truly disturbing. Inflation at 4.1% means your $10,000 loses $410 in purchasing power. In 1 year, you didn't just earn nothing, you lost $370 in real value. That represents approximately 15 hours of your labor. 15 hours you worked, taxed, saved, and then watched evaporate because you trusted the system. The bank didn't steal it. Inflation did. But the bank facilitated the theft by offering you a return so pathetically low that it guarantees your loss. And they know it. Every financial institution knows it. This isn't incompetence, it's design. Let's go deeper into the mechanics of this trap. When you deposit money in a bank, you're not actually saving it. You're lending it to the bank at terms that would make a loan shark blush with shame. The bank takes your money and lends it out at rates between 6% and 24%, depending on the product. Credit cards, personal loans, mortgages. They're making that spread on your capital while paying you scraps. The business model is elegant in its exploitation. You provide the capital, they take the risk with it, they earn the return. You get the illusion of safety and the interest rate that doesn't even cover the inflation tax. Meanwhile, your purchasing power, which is the only measure of money that actually matters, declines steadily. This is the hidden tax that no one votes for, but everyone pays. Governments print money to fund deficits. That new money dilutes the value of existing money. Your money, the savings you accumulated through sacrifice and delayed gratification, become worth less. Not worthless, but worth less every single day. And the rate of this theft has been accelerating. Look at the historical data from 1960 to 2000. Average inflation in the US was around 4%. From 2000 to 2020, it dropped to about 2.3%. People got comfortable. Then 2021 hit. Inflation spiked to 4.7%. In 2022, it exploded to 8%. Suddenly, that $10,000 in your savings account lost $800 in purchasing power in a single year. That's 32 hours of work for someone making $50,000 annually. 32 hours you'll never get back. But here's the psychological trap that keeps people stuck in this system. Safety feels good. The FDIC insures your deposits up to $250,000. That insurance creates a perception of zero risk, and humans are wired to avoid loss more strongly than we're motivated to pursue gain. This is called loss aversion, and it's one of the most studied phenomena in behavioral economics. Banks exploit this bias ruthlessly. They market savings accounts as safe, secure, and responsible. They're not wrong about the security. Your nominal dollars are safe, but your purchasing power, your actual wealth, is being systematically destroyed. It's like having a fireproof safe that slowly fills with water. The safe works perfectly. Your stuff still drowns. Let's run a longer-term scenario to really hammer this home. Imagine you're 25 years old. You save $100,000 through incredible discipline. You put it in a savings account earning 0.5% interest. You leave it there until you're 65, 40 years. In nominal terms, at 0.5% annual interest, you'll have about $122,000. Sounds like growth, right? Now factor in inflation at a modest 3% average over those 40 years. To have the same purchasing power as your original $100,000, you would need about $326,000. Your $122,000 in nominal dollars has the purchasing power of about $37,000 in today's money. You didn't preserve your wealth. You destroyed 63% of it by trying to keep it safe. You would have been financially better off spending that money on experiences when you were 25. At least you would have gotten utility from it. This is the time theft aspect that people rarely calculate. Money represents a stored time. When you work, you're converting your finite life hours into currency. That currency is supposed to hold value so you can use it later. But when inflation outpaces your returns, you're working in the present to create purchasing power that disappears before you can use it in the future. You're running on a treadmill that's slowly speeding up. Every year, you have to run faster just to stay in the same place. So what's the alternative? This is where most financial content fails. They diagnose the problem but offer no actionable solution. Or worse, they pitch some scam. I'm not selling anything, so let's talk real options. First, understand that some liquidity in a savings account is necessary. Emergency funds should be accessible. 3 to 6 months of expenses in cash makes sense. But anything beyond that is a guaranteed loss in real terms. For money, you don't need immediately. You need assets that outpace inflation. Historically, that's meant stocks, real estate, and commodities. The S&P 500 has returned about 10% annually over the long term. Real estate has appreciated roughly 3% to 4% above inflation. These aren't guarantees, and they come with volatility. But the guaranteed loss of purchasing power in a savings account is also a risk. It's just a risk that feels safe because it happens slowly. This is crucial to understand. Volatility and risk are not the same thing. A stock portfolio might drop 20% in a bad year. That feels risky. But a savings account that guarantees you lose 3% to 4% in purchasing power every year is also risky. It's just certain risk versus uncertain risk. Most people prefer a certain loss over uncertain gain. That preference keeps them poor. Another option is inflation-protected securities, like TIPS, Treasury Inflation-Protected Securities. These are government bonds that adjust their principal based on inflation. They're not exciting, but they preserve purchasing power much better than traditional savings accounts. Or consider Series 1 savings bonds, which adjust their rates based on inflation. They're limited in how much you can buy annually, but they're a far better option than letting money rot in a standard savings account. The deeper point here is about financial literacy and the intentional complexity of the system. Banks don't advertise the inflation-adjusted returns on savings accounts. They highlight nominal rates. Financial media talks about market returns but rarely discusses real returns after inflation. This isn't an accident. An informed population would demand better. They would move money out of low-yield accounts into assets that actually preserve and grow wealth. That would force banks to compete on rates. It would reduce the cheap capital available for banks to lend at high margins. The current system works beautifully for financial institutions. It works terribly for savers. And it's completely legal. There's no fraud here. Just a massive information asymmetry and behavioral exploitation. So here's your action point. Calculate your real return. Take your savings account interest rate. Subtract the current inflation rate. That's your real return. It's almost certainly negative. Now calculate how many hours of your life you worked to generate the money in that account. Multiply your negative real return by your account balance. That's how much purchasing power you're losing. Divide that by your hourly wage. That's how many hours of your life are being stolen annually by inflation while your money sits idle. Once you see it in terms of your time, the emotional weight changes. It's no longer abstract economic theory. It's your life, your finite existence, being converted into currency that's systematically devalued. You can't stop inflation. You can't change monetary policy. But you can stop volunteering to be the victim of it. Move money out of savings accounts beyond your emergency fund. Put it into assets that have a fighting chance of outpacing inflation. Accept that nominal safety is not real safety. Real safety is preserving purchasing power across time. That requires taking on some volatility. But volatility is temporary. Inflation is permanent. One might hurt in the short term. The other guarantees you lose in the long term. Your time is all you have. Every hour you trade for money should be respected enough to protect its value. Letting it decay in a savings account isn't responsible. It's financial self-harm in slow motion. The trap is comfortable. The trap is socially acceptable. The trap is what everyone else is doing. But it's still a trap. And every day you stay in it, you're working for free for a system that is designed to transfer your wealth upward while making you feel prudent for participating. Calculate your real return. Face the number. Then make a different choice. Your future self, the one who doesn't have to work extra years because their savings evaporated, will thank you.